Welcome to The Explainer. It is May 13th, 2026, and let's jump right into an absolutely fascinating paradox that is completely dominating the crypto market today. We are looking at a real tale of two markets, the institutional sponge versus the retail ghost town. We're seeing this massive, deepening divide between big institutional capital on one side and everyday retail participation on the other. It is literally like watching two completely different realities play out on the exact same day. To really get a handle on this paradox, we've got to talk about the absolute viewership crisis happening on YouTube right now. It's wild. Prominent crypto creators are reporting this really strange phenomenon. Take Carl Runefelt, for example, known as Carl Moon to his 650,000 subscribers. He recently came out and said, "Even at the 2018 bear market, I had double the views." I mean, just think about that for a second. Despite everything happening out there, retail engagement, the everyday folks searching for crypto content, leaving comments, just participating in the community, is an absolute ghost town.
And the reason this is such a crazy paradox is because right at this very moment, Bitcoin is actively knocking on the door of all-time highs. We are hovering right around $77,439. We're talking massive asset valuations, huge green candles, and the kind of market strength that usually triggers an absolute frenzy of public attention.
So, what gives? How on earth can we have historically high asset prices, but everyday retail investors are just completely checked out? Where's the hype? Where's that retail euphoria that almost always shows up when prices near $80,000? And more importantly, what does it actually mean for the market when the usual retail indicators just go completely silent?
Well, to answer that, let's head into Section 1, the institutional liquidity sponge.
If retail is sitting on the sidelines, somebody has to be doing the buying, right? And the contrast here is just stark. Over in retail land, the Fear and Greed Index is sitting at a dismal 21 out of 100. That is firmly in extreme fear territory. But then you look at the other side, and massive capital is flowing in from traditional finance banks and political figures. We're seeing disclosures like South Carolina Congresswoman Sheri Biggs officially investing up to $250,000 into a Bitcoin ETF. Digital assets have basically become a permanent fixture in political and institutional portfolios, and they are completely detached from the fear that's currently gripping the retail crowd.
And you can really see the sheer volume of this capital when you look at Wall Street's expanding appetite. Today is actually the first full day of market discovery for the Hyperliquid ETF, ticker THYP, over on the Nasdaq. Everyone's watching this as a massive proxy test for Wall Street's appetite for decentralized perpetuals. Meanwhile, Morgan Stanley Spot Bitcoin ETF just officially crossed $100 million in inflows, and that's in just its first 6 days of trading. Major U.S. banks are successfully converting their high-net-worth clients into crypto holders. These clients aren't watching YouTube videos to make decisions, They are allocating quietly through their wealth managers.
So the takeaway here is actually pretty crucial. Historically speaking, when you have this kind of retail exhaustion, while prices stay this high, it tells us the market is being driven by a much stickier class of capital. We're talking about institutions and ETFs that hold firm, not flighty speculators looking for a quick day trade. Structurally, this implies lower short-term volatility, simply because this kind of capital does not panic sell the second they see a red candle.
But look, it's not all smooth sailing. Let's move to Section 2, new regulatory friction, because a pretty major speed bump just hit the wires today.
Senator Richard Blumenthal has formally requested updates from the Department of Justice and FinCEN regarding the monitors currently overseeing Binance. He's citing concerns over what he calls dangerously lax anti-money laundering compliance, and specifically pointing to reports of $1.7 billion in financial flows involving Iran. So make no mistake, this is a very serious inquiry. You have top federal enforcement agencies probing the largest infrastructure provider in the entire crypto industry.
But I want you to connect the dots for a second. Normally, if you get headlines about the DOJ and FinCEN probing a massive exchange over billion-dollar compliance issues, the market absolutely tanks. We'd be looking at double-digit percentage drops in a matter of hours. So, why hasn't this triggered a massive panic sell-off today?
It all comes back to what we were just talking about, that sheer buying pressure from the traditional finance giants, the Morgan Stanleys and Charles Schwabs of the world, is completely neutralizing the bad news. This massive volume of ETF capital is literally acting as a liquidity sponge. Any panic selling, triggered by those regulatory headlines, is just getting soaked up by automated institutional inflows on the other side. The new market structure is fundamentally absorbing the shock.
Which leads us perfectly into Section 3, the Clarity Act catalyst, because there's a ticking clock right now that could completely upend this delicate balance.
Right now, we are officially sitting on markup eve. Tomorrow, May 14th, the Senate Banking Committee holds its crucial markup of the CLRD Act. Across the industry, this is widely seen as the ultimate make-or-break moment for U.S. stablecoin regulation. The language that gets finalized in this markup is going to dictate exactly how digital dollars function in the American economy for the next decade.
And the stakes for tomorrow's vote are incredibly high. The Clarity Act actually has the potential to legalize stablecoin yields for everyday holders. The market is already pricing this in aggressively. Circle stock is rallying 15% just anticipating a breakthrough here. But on the flip side, the American Bankers Association is fighting back hard against the bill. They are warning that if we legalize these yields, we'll see a massive deposit flight. Basically, consumers would pull their money out of traditional low-yield bank accounts to chase higher yields in digital stablecoins.
Okay, so bringing all of this together, let's jump to Section 4. Market Outlook. What's next?
When we map out the short-term triggers, we're seeing a current market floor establish itself right around that $77,000 mark. And that's almost entirely thanks to that institutional ETF absorption soaking up the selling pressure. But looking upward, the short squeeze target is sitting near $85,000. If that Senate markup tomorrow provides a favorable regulatory signal for stablecoin yields, the sheer weight of this institutional money could squeeze prices up rapidly, forcing anyone betting against the market to scramble and cover their shorts.
Which leaves us with one final massive question to chew on as we watch the Senate tomorrow. If the Clarity Act passes with favorable language for yields, what happens to the global financial system if traditional money market funds suddenly start rotating their massive capital reserves out of legacy systems and directly into on-chain yield products? That is the trillion-dollar catalyst the market is holding its breath for. Thank you so much for joining this explainer. Keep your eyes on the data tomorrow, and we'll see you next time.